Once again, my name is Michael Grandy, and I'm a professor at Providence College. This semester, I'm teaching MBA 603, which is essentially managerial accounting. And we are going to continue our discussion about job order costing. So we're using the PowerPoint presentation from the Garrison Noreen textbook, 17th edition, and specifically we're going to look at chapter 3. So what we talked about in the previous chapter, chapter 2, it was a conversation about assigning and calculating with as much detail as possible product cost. Using a job order costing system, we wanted to allocate, identify direct materials cost, direct labor cost, and manufacturing overhead cost to our product. And we did that on a product basis, on a unit basis. What we're going to do now is we're going to look at the journal entries associated, because what's going on is it's not just a job order costing system, we have a general ledger system. And we want to know how the costs flow, how the costs build up in our accounting system. And what we really need to remember here is the matching principle. And the matching principle specifically says that you need to match revenue and expense in the same accounting period. What does that mean? Well, that means that if we are making a product, we cannot expense the cost of that product until we sell it. How do we do that? Well, all of the costs of manufacturing our product, the direct materials, direct labor, and manufacturing overhead have to be accounted for, and specifically need to be put on the balance sheet until we sell it. So we're going to see we have multiple balance sheet accounts that are classified as inventory, they're assets, specifically raw materials, work in process, finished goods, and a temporary balance sheet account, a temporary inventory account called manufacturing overhead. All of those costs, all of the costs of making our product, direct materials, direct labor, manufacturing overhead, need to be put into inventory on the balance sheet until such time as we sell it. When we sell the product, we're going to record two transactions. The first transaction is to record the sale. Debit accounts receivable, credit sales revenue for the sales price of our product. The second journal entry that happens at exactly the same time as we sell it in the same accounting period is a debit to the cost of goods sold and a credit to finished goods inventory. You can see those two journal entries do what? They match revenue and the cost of goods sold in the same accounting period. Again, the sales journal entry is pretty straightforward. Debit accounts receivable, credit sales revenue. The second journal entry, debit cost of goods sold, credit finished goods. But here's the tricky part. For how much? How much, what was the cost of making that product? And that's what we need to keep track of. We need to keep two things in mind. Number one, we need to account for the flow of those costs through our system. And secondly, we need to keep track of the cost per unit, the cost of our product, cost per unit. That's where job order costing comes into play. So let's get started with the PowerPoint presentation. So we get job order costing, cost flows, and external reporting. So there's some important vocabulary here. There are 7 important vocabulary terms that were introduced in the previous chapter. Job order costing, the costing system used in situations where many products, jobs, or services are produced each period. Houses, airplanes, yachts. Absorption costing, a costing method that includes all manufacturing costs direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of our product. So we need to absorb it. We need to account for all of it, and we put it in our product. We put it in inventory until such time as we sell it. The equation shows how to calculate the predetermined overhead rate. We have an allocation base, and we have predetermined overhead rates, which we learned and talked about in chapter 2. We have overhead application, the process of assigning overhead costs to specific jobs using the formula, right? Overhead applied to a particular job equals the predetermined overhead rate multiplied by the amount of the allocation factor incurred. A job cost sheet is a form that records materials, labor, and overhead. We've seen all that. That was chapter 2. So here are the two big learning objectives that we have here. Number one, understand the flow of cost in the job order costing system and prepare the appropriate journal entries to record that. There's a lot of journal entries in this chapter. And then 2, using T accounts to show the flow of cost in the job order costing system. So these are 4 very important aspects. The first 3 are inventory. The last one is an expense. Raw materials include any materials that go into the product. So the easy way to remember raw materials is that these are the materials that go into our product, but more importantly, they are untouched. They haven't been started yet. Work in process consists of units of production that are only partially complete and will require further work before they are ready for sale to customers. So this is work in process. A nice definition for this is started but incomplete. So this is our furniture warehouse, our furniture manufacturer who makes desks, and somebody has started working on desks. Maybe there's 5 desks in this work area, and this employee is working on all of them. Some of them are 5% complete, some of them are 50% complete, some of them are 95% complete. But the fact of the matter is that they are all incomplete. So work in process is started but incomplete. Finished goods consist of completed units of product that have not been sold to customers. So these first 3 items are all part of inventory: raw materials, work in process, and finished goods. Finished goods, completed but unsold. And then lastly, the cost of goods sold includes the manufacturing costs associated with the goods that were finished during the period. And I would say cost of goods sold is what was sold. So here's a schematic on the flow of costs through our balance sheet, through our financial statements. You have raw materials, direct labor, manufacturing overhead, and you can see they all go on the balance sheet. When they are completed, the costs are moved to finished goods inventory. When they are sold, they then go to the cost of goods sold. Again, we cannot expense the cost of our product until we sell it. Non-manufacturing costs, also referred to as period costs, are expensed in the period in which they are incurred. Again, we saw in chapter 1 a bunch of different costs, and you needed to identify them and put them in the right place. Job order costing. So this is an extensive problem that we have a company that makes has two different jobs going on, and we're going to follow the flow of costs through the financial statements, through the general ledger, and there's going to be a bunch of journal entries. This is also an example that's in your textbook that you can follow. So to illustrate the cost flows within a job order costing system, we will record Rugger Corporation's transactions for the month of April. Rugger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April. Job A, a special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started during March, the previous month, and completed in April. As of March 31st, Job A had been assigned $30,000 in manufacturing costs, which corresponds with Rutgers' work in process balance on April 1 of $30,000. So they got $30,000 cost in this already that are on the balance sheet in inventory, specifically work in process. And then they're working on Job B. In order for 10,000 silver medallions commemorating the fall of the Berlin Wall was started in April and was incomplete at the end of the month. Excuse me. So here are some T accounts. You're familiar with those that we're going to be working with. The first one is raw materials. Second one is work in process. Third one is manufacturing overhead. So if we look at and these are all inventory accounts. Raw materials inventory, the debits represent purchases of raw materials, and credits represent amounts that are transferred out. And those materials can be transferred out in two different places: work in process and manufacturing overhead. Now, what's important and what we're going to see here is the work in process T account includes three things on the debit side. On the debit side, the work in process account will show direct materials, direct labor, and manufacturing overhead applied. In the manufacturing overhead T account, which we're going to become very familiar with, the debits represent actual costs and the credits represent applied to work in process. The debits in the manufacturing overhead account will include three things by definition: indirect materials, indirect labor, and other factory costs. So let's look at some of our journal entries. On April 1, Rutgers Corporation had $7,000 in materials on hand. During the month, the company purchased on account an additional $60,000 in raw materials. So we don't expense them. We put them on the balance sheet. We put them in an asset. We put them in an inventory account called raw materials. During April, materials requisitioned were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. These raw materials included $50,000 of direct, $2,000 of indirect. So let's remember, by definition, work in process includes direct materials, direct labor, and manufacturing overhead applied. Manufacturing overhead includes indirect materials, indirect labor, and other factory costs. So this is what they did here, right? They put the direct materials into work in process, and they put the indirect materials into manufacturing overhead. So now we're going to take a look at labor costs. In April, the employee time tickets, which provide hourly summaries of each employee's activities throughout the day, included $60,000 recorded for direct labor and $15,000 for indirect labor. The following entry summarizes. So once again, direct labor goes into work in process, indirect labor goes to manufacturing overhead. And again, we're going to see the third component of manufacturing overhead, right? Manufacturing overhead debits indirect materials, indirect labor, and other factory costs. Assume that Rutgers Corporation incurred the following general factory cost, operative word factory: utilities on the factory, rent on the factory, miscellaneous factory costs, totaling $40,000. These are other factory costs. You debit manufacturing overhead. So the next thing we need to do is we need to transfer out some of the manufacturing overhead costs into work in process. So we need to debit work in process and credit manufacturing overhead. But What is the amount? The amount is going to be based upon a predetermined overhead rate. Assume that Rugged Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours worked on job B for a total of 15,000 hours. Thus, $90,000 of overhead would be applied to work in process. Manufacturing overhead applied equals the predetermined overhead rate multiplied times the actual activity. Here's a journal entry. Increase work in process, credit manufacturing overhead. What about non-manufacturing costs? What about period costs? Non-manufacturing costs are not assigned to individual jobs, rather they are expensed in the period incurred. Examples: salary expense for employees who work in marketing, selling, and administrative capacities, as well as advertising expenses. Here are some examples of period costs, non-manufacturing costs. The one that I really want to emphasize is journal entry number 7, depreciation on office equipment. Operative word there is office. See where it goes? It goes to depreciation expense. If that entry had said depreciation on factory equipment, the debit would be manufacturing overhead. But because it's office, it goes to a selling and administrative expense called depreciation expense. So once a job is completed, we need to transfer the cost to finished goods. We're going to debit finished goods, I'm going to credit work in process. But for how much? So what they're saying here, job A was completed during April and job B was incomplete at the end of the month. Thus, the following entry transfers the cost of job A from work in process to finished goods. They've determined that the amount that was associated with job B was $158,000. Now, there's a job cost sheet out there that will explain it to you. It's in the textbook, where they allocated the cost between job A and job B. It's not on this PowerPoint presentation, but if you're looking at a textbook, they keep track of job A and job B. They've determined the costs associated with job B were $158,000. All this entry does is transfers the cost of the completed project to finished goods. Now, at some point in time, they're going to sell this product. And then they need to transfer that cost once again. So they've determined for Rugged Corporation, we will assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total sales revenue of $225,000. Because 1,000 units were produced and the total cost of the job was $158,000, the cost per unit is $158. They sold 750. So journal entry 10 does what? Records the sale. Debit accounts receivable, credit sales revenue. Journal entry 11 satisfies the matching principle, where they record the cost of the sale. Debit cost of goods sold, an expense account, credit finished goods inventory, a balance sheet account for the cost. 750 medallions times $158 per medallion is $118,500. We're going to skip learning objective 3. So pardon me while I move through this quickly. My apologies. So learning objective number 4. This is important. Compute the underapplied or overapplied manufacturing overhead and prepare the journal entry to close the balance in manufacturing overhead to appropriate accounts. So keeping track of the manufacturing overhead T account is very important. Manufacturing overhead account is classified as a balance sheet account, an inventory account, but it's a temporary account, which means that we have to close it out periodically because it may include excess costs or over-applied costs, and we need to resolve it. Now, the manufacturing overhead T account has debits and credits. The debits in the manufacturing overhead T account represent actual costs for indirect materials, indirect labor, and other factory costs. The credits in the manufacturing overhead T account represent amounts applied to work in process, amount transferred out to work in process. Based upon the formula, manufacturing overhead applied equals the predetermined overhead rate multiplied times actual activity. So what we're going to do now is we're going to compute the underapplied or overapplied and prepare the journal entry to close it out. So here's some definitions of underapplied and overapplied. So underapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. So in this example, underapplied means the actual costs were greater than the amount transferred out. It also means that the manufacturing overhead account has a net debit. Underapplied. Overapplied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. It means they put too much cost. Remember, the debits represent actual costs and the credits represent applied to, but they're also an estimate. Why are they an estimate? They're an estimate because the predetermined overhead rate is an estimate. Remember what the predetermined overhead rate is. Total estimated manufacturing overhead divided by total estimated activity base. Hence, the predetermined overhead rate is an estimate. Therefore, the amount that's applied to work in process is also an estimate. So there will always be a difference. There will also always be something left over in the manufacturing overhead account. It could be a net debit, which is underapplied, or it could be a net credit, which is overapplied. They put too much in there. So what are we supposed to do with it? So let's look at an example. Peerco's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. Peerco's predetermined overhead rate is $4 per direct labor hour. Overhead applied during the period. Predetermined overhead rate multiplied times actual activity. So they transferred $680,000 to work in process. So they had a debit in manufacturing overhead of $650. They had a credit of $680. They have a net credit of $30,000. In other words, they have over-applied manufacturing overhead. They put too much cost in their product. Over-applied. What are we supposed to do with it? This is an account that needs to be dealt with ideally on a quarterly basis. I would suggest it should be done on a monthly basis. Here's another example. Tiger Inc. had actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour. They worked 290,000 machine hours during the period. Tiger's manufacturing overhead is what? Remember, the debits represent actual costs. The credits represent applied to. Overhead applied, 1160. The under applied, the debits were 1210, the credits were 1160. They under applied, they have a net debit of $50,000, a net debit in that account. Any remaining balance in the manufacturing overhead account, such as Peerco's $30,000 of over applied, right? Peerco was over applied, a net credit is disposed of in one or two ways. Number one, it can be closed to the cost of goods sold. Or two, it can be closed proportionately to work in process, finished goods, and cost of goods sold. So what's important here is to understand two concepts. Number one, materiality, and number two, the matching principle. Now, if the amount that's left over is immaterial, means insignificant, means a small number, then it's appropriate to use method one where you close it to the cost of goods sold. But if you want to really satisfy the matching principle, remember, you only expense the cost of your product until you sell it. Maybe you haven't sold everything. And if you haven't sold everything, then you should not expense this leftover cost. Disposition of overapplied, underapplied. So the journal entry in T account form to close out Peerco's $30,000 of overapplied to the cost of goods sold. So you look at Peerco's, on the right-hand side, Peerco's manufacturing overhead account. The actual cost was $650. The amount that was transferred out was $680. So they overapplied. So in order to zero out that account, they need to zero out manufacturing overhead. They're going to debit manufacturing overhead to bring it to zero. And they do what? Close it to the cost of goods sold. In this case, credit the cost of goods sold. Calculating the allocation of underapplied or overapplied overhead between work in process, finished goods, and cost of goods sold. Let's assume the overhead applied in ending work in process inventory, ending finished goods inventory, and the cost of goods sold is 68,204 and 408. Total value of 680. So those are the amounts that were applied. So in the case of the allocation percentages for work in process, finished goods, and cost of goods sold would be applied the following way. So what they're saying, they're looking at ending work in process inventory. They're looking at the amounts. It's relative to how much was applied. They're just coming up with an allocation factor because what they're saying here, only 60% should be expensed to the cost of goods sold. The other 40% belongs on the balance sheet. That's really what they're saying. So here's how they allocate that $30,000 of overapplied. Here's the journal entry. Again, the key is to close the manufacturing overhead account. Had a net credit, you need to debit it to bring it to zero. So in summary, there's two ways for disposing of the underapplied or overapplied. The first one is to close it out to the cost of goods sold, which is the easiest way. The second way is to make an allocation. It's considered more accurate, but it's more complex. What effect will overapplied overhead have on net operating income? So remember, you have a net credit in manufacturing overhead. To dispose of it, you need to debit manufacturing overhead and credit what? Cost of goods sold. Net operating income will increase because you're going to decrease in expense, increases net income. So the good thing is that I will assign a handout that walks through all the journal entries and job order costing, but has an example where we do not close the overapplied or underapplied to the cost of goods sold. So that's the end of this particular video PowerPoint presentation. Once again, thank you.